Welcome back to the Marathon Mortgage Happy Hour. I'm Mike Witzak.
My name is Rory Farrell.
And today we have, go ahead.
The specialist of guests.
Yeah, I kind of like messed that up, actually. I feel weird now.
Usually I'm the one messing up the intro.
Yeah, that was weird. All right, start from the top. Wow, that was the first time I've done that, I think, ever.
You want me to do it?
Yeah, go ahead, give it a shot.
Welcome back to the Marathon Mortgage Podcast.
No, wrong. All right, I'll just do
Suck at it.
Here we go. Welcome back to the Marathon Mortgage Happy Hour. I'm Mike Witzak.
My name is Rory Farrell.
And today in the middle, we have the specialist of guests.
Tom Howell.
Hey, there we go.
Tom Howell, president, owner, confidant, best friend.
Financier of the podcast. Yeah.
Thanks for coming on.
Yep, thanks for having me.
Yeah. So the reason that, I forgot about the beer.
Well, first off, yeah, it is actually Friday.
It is actually
the first
Friday.
time we're recording on a Friday in a while.
I don't know if you can see. It's 10:26 a.m.
Hell yeah.
And the only reason we're drinking a beer is because Tom requested it. The owner of our company is like, why are we not drinking a beer?
Yeah.
So here we go. Tired Hands, Pineal. Thank you, Mike, for picking this up the other week.
I picked this up?
Yeah.
No, incorrect. Did I pick this up? Oh, I thought I did pick this up. Yeah, you're right. Holy shit. I totally
Tired
forgot
Hands.
that I was there.
There you go.
That's so funny.
IPA with honey. Tired Hands, as we know, is one of the best breweries in the country, but certainly in the area.
Did you just leave it here?
Yeah, I left it here for the podcast.
Oh, no way.
Cheers, guys.
Cheers.
Happy Real Friday.
Yeah.
Good morning.
Good morning. I would have just like split the Venmo with you, dude. I didn't know you're keeping it here for the podcast.
All right, cool.
Whatever. Okay.
Well, good beer. It's perfect for 10:30 in the morning.
Good with me. I got a settlement and a lot of people to call today, so.
All right, so Tom has some important information. I asked him to come on, or we asked him to come on because the other day he spoke with one of my teams. Shout out Home Experts for you guys. We got Mike Soroka and Matt Donnelly and his crew were really inquiring of what we thought was going to happen in 2025 and what the state of the market is and expectations and things like that. I couldn't make it, and Tom really was the better person to have that conversation anyway because you're the expert. So
yeah, Tom's the translator of Jerome Powell in the office. When the Federal Reserve comes on and talks, you don't understand what he's saying if you listen to him, but Tom does. So he kind of translates and breaks it all down. So.
Yeah, so I think we can kind of like break this down today too. And I think
Let's do it.
The big thing is when people hear rates are being cut, what does that mean? What you just hear, rates are cut, rates are cut. So what does that mean?
I mean, people don't care as long as they're cut. They don't do any other research.
Yep.
Yeah. And actually, if I'm a normal person, I think they're cutting mortgage rates too. I think they're just like, oh, we're cutting rates and all rates are getting cut, but not everybody knows what they're doing.
I searched that up yesterday just to see what it says. And when you search it up, it's like what rates were cut. Mm-hmm. So the rates that get cut, prime gets cut, the Fed funds rate gets cut, the discount rate gets cut. So prime, like a home equity line of credit, is tied to prime. Mm-hmm. So if you have a home equity line of credit, prime gets cut, that rate is going down. It's a direct impact.
Okay.
Mortgages, the majority of mortgages are Fannie Mae, Freddie Mac mortgages. So Fannie Mae, Freddie Mac is it's a mortgage-backed security that you could buy. You could go on Wall Street, you could buy this mortgage-backed security. You could buy this mortgage-backed security. So when the Fed is cutting rates, they're not going into Fannie and Freddie and cutting those rates.
Okay.
Now, by cutting the discount rate, by cutting the Fed funds rate, that can affect portfolio lenders. It can help bring down their rates. So rates on auto loans might go down. Rates on personal loans might go down because your banks have, by the discount rate being cut or the Fed funds rate being cut, their cost of borrowing is going down.
Okay.
So there is, they're either picking up more margin or they could pass that through to consumers in some of the money that they lend. But if you look at Fannie Mae and Freddie Mac, again, they're just traded on Wall Street, and those rates kind of move up and down based on what the traders believe is going to happen with rates in the future. So what I always like to say to people is today's rate is the expected rate of the future. So you have buyers of mortgage-backed securities. They're mainly buying a mortgage-backed security because they feel that that rate is going to go down in the future. And mainly the seller of a mortgage-backed security feels that that rate is going to go up in the future. So if you have 50% of the people essentially believing one thing, 50% believing the other, that really makes more or less a perfect market. Yeah. So you're taking these financial minds on Wall Street that say, hey, based on today, this is where we think the rate should be. And these financial minds have, great experience with what they think is going to happen in the future.
Yeah, and I think just to kind of preface that too, it doesn't always make sense as to like why some rates go up and down. I'm sure you could look at economic indicators, but a lot of Wall Street, like, they might buy off of a rumor and sell off of a rumor, or do things based off of rumors that aren't necessarily true. So just because the Fed cuts rates doesn't mean that our rates are going to go down at all. It means nothing. Yeah.
Yep. So basically, something that happened just yesterday, there was a Fed rate cut of 0.25%, and our rate stayed more or less flat. They trended up a little bit. Mm-hmm. The prior Fed rate cut was 0.5%. After that cut, very soon after that cut, so the cut, I believe, was on a Wednesday, and then that Friday, an economic report came out, the PPI, and the PPI reading was higher than people had expected. And that economic report kind of set the market off to say, hey, the Fed just cut rates. They cut rates 0.5%. They were cutting the rates because they were feeling that inflation was tame, inflation was under control, the economy maybe needed a little bit of a boost. So the Fed's saying, okay, we're going to go in, we're going to cut rates 0.5%. And then 2 days later, this PPI reading comes out that shows that, hey, the producer price index is showing that things are more expensive. There's still some signs of inflation. So Wall Street looked at that and thought, wow, the Fed just cut 0.5%. Things are already a little too heated based on this report. So rates went up. So instead of rates going down 0.5% that people expected, rates actually went up 0.5%. So the economic reports are really the thing that drives Wall Street's belief in where the future, rates should be. And that's really the thing that drives the direction. So when economic reports are coming in showing signs of inflation, when economic reports are coming in showing that there's very little job loss, things like that are showing, okay, this economy is doing well. There's signs of inflation in this economy, and that leads to, stable or potentially raising rates in the future. And if the Fed cuts rates in the face of that, the Fed's more or less adding fuel to that fire. They're saying, okay, we're cutting rates to stimulate things. Wall Street's saying, hey, things are already stimulated. Things are already pretty good. So that's why rates went in the opposite direction of the cut.
Yep.
And again, it's Fannie Mae, Freddie Mac really specific that I'm talking about, mm-hmm. because the rates that the Fed is cutting, they do have some impact on some other types of loans.
Yeah.
And you mentioned the economic reports. If you're out there and you're a realtor or a buyer and you're like, hey, I do want to pay attention to this. Previously, I thought it was the Fed funds rate I should be paying attention to. Maybe they should be paying attention to CPI, PPI.
Yeah, and that really kind of like gets in the weeds and gets a little bit harder for people to follow. But it's really, that's the gist of it, is if this economy is doing well and there's job growth and there's signs of inflation, or inflation isn't coming down at the rate that we had hoped, those are all the things that can lead to higher rates. Yeah. Now, there's so much that plays into it. I mean, just the deficit plays into it, and the issuance of bonds and how many bonds are being issued. And there's so many directions you can go with it. But I think the idea behind this podcast is when you hear the Fed is cutting rates, it does not mean that mortgage rates are coming down.
Yep.
Sometimes they go hand in hand, because sometimes the economy is weakening. The Fed's cutting rates to help speed things up. The Fed's trying to continually cut rates. The Wall Street's looking at it and saying, hey, we need these Fed cuts. We need future cuts. When you have that, you'll see rates will continually trend down. But it's really whether you're deciding to refinance, whether you're deciding to buy a house, when you're looking at today's rate, that is really the expected rate of the future. And that's really the best way to explain it, in my opinion.
Yeah, I agree. And I think, it goes to talk about everybody wants to wait until like the right time to purchase. I think we spoke about this before, but I don't think there is a right time. There never is. So it's like if you could afford to do it now, rates go down in the future, refinance, get a lower payment, and you still got the house you wanted. So I don't think there is a right time, or if there's like a, hey, in Q1 of next year, rates are going to be lower. We've heard that a million times. That's not the truth. So if you can afford to buy and you want to buy a house now, go buy a house. You know?
And from a monthly payment standpoint, really that's what most people really care about. It's like, what is your monthly payment? And the difference in an eighth or a quarter or even like a half in rate might be completely thrown off if you buy a house that has an extra $2,000 in taxes. So it's like you got to look at the monthly payment as a whole when you're in the market and say, can I afford this now? Am I comfortable with this? If I get to refinance down the line, great, even better. But this house with these taxes, with this mortgage insurance and homeowners and with this rate, can I afford it and am I comfortable with it?
Yeah.
And if you can, boom, buy the house. You're building equity over the next couple months and years. And then if there's a chance to refi, you refi.
Yeah. I think time and time again, if you look at our customers over years, many years, it's home prices go up in value. Owning real estate is a great idea. If you're going to buy a house and you're going to own it for a long period of time, it makes sense. The math works out.
Yeah. Yeah. And you've seen it in your own life. We've all seen it with our own investments. So I think that was a good way to kind of dumb it down for everybody and explain it. It's good.
There we go.
Perfect.
Love it.
Our very own personal Jamie Dimon in the house, or Diamond, whatever his name is. So happy Friday. Done.
Happy
Anything
Friday.
else? Yeah.
Happy Christmas. Happy
The guy
New
who
Year.
didn't want a beer is the only one who drank it.
Yeah.
Well,
I
kept my mouth shut and listened.
Yeah. Great. All right.
Yep.
If there was a coffee there, Joe, that would have been finished.
Yeah, that probably would have been a better idea.
Yeah.
Yep.
All right. Well, happy Friday. Merry Christmas. Happy New Year. Happy holidays. And enjoy some breaks. Bye.
It's